Lance here. In this video, I want to show GLD and GDX. GLD is the Spider Gold Trust ETF and GDX is the gold miners. Now you would think, since they're both gold and in a time of panic in the markets, gold would be a nice hedge. You can really be misled on what you're buying when you look at GLD versus GDX. Here's what I want to show you. Daily chart here of GLD first of all. Let's actually zoom in when we have these volatile times here. So we notice down below, this is implied volatility. It's a free study on TD Ameritrade. Pretty much every platform has it. You just type in IMPV, implied volatility will pop up there. So we can see, obviously, when markets are volatile, everything, including gold, is going to be volatile. So implied volatility is high. Now we can see GLD historically here on the daily just made a new high about 3 days ago. Now I want to pull up GDX. Okay, this paints a whole different picture. So GDX here, this stock, the gold miner ETF, is very, very weak compared to GLD. We're seeing, look at this, about a $6.50 move from the highs here in GDX, because you have to figure, despite spot gold prices, so you could look at /GC, the gold futures, or really any platform for gold futures, the gold miners still make up individual stocks. You have top names like Newmont, Barrick Gold. They merged with Rheingold recently. But these very popular gold miners here, they're still going to fall with the overall market, even though they're gold. And if gold goes higher, you would think they go up. So just one more showcase here. I'm going to pull up side by side, and we can add a study. So we're going to go to add study, and we're going to go to compare. Now we're going to compare this with, we'll actually do a couple custom symbols. We'll do GLD, so we'll do GDX to GLD. Okay, now again, this is GLD right here, obviously very strong compared to GDX. Now what I want to do, compared to the gold miners GDX, is I'm going to compare it with spot gold. So that's /GC, and that's just the gold futures there. And click OK. And we can see spot gold, let's zoom out a little bit here. Spot gold actually holding up a lot better than GDX too. So I will say, if you think, you have a good hedge, so to speak, right? We can even overlay with the S&P if we want. And if you think stocks continue to move lower, look at GLD. In my opinion, not GDX for a hedge. So we'll compare the S&P till GLD here. Look at that. GLD, obviously outperforming the S&P. And what you also notice too, this line here, this line chart is GLD. The candles are S&P, the SPX. You can notice here too, as the market rallied, you actually had gold rally for the back end of 2019 and even 2020. And then one other thing I want to show here is I really want to show this pre-market here, just because today it's so valuable as an example here. You're having the S&P futures are down about 5% here. They actually got halted, limited down here, right? And I want to pull up gold futures here. Gold futures are down 2%. Okay, so again, just the way of thinking, and I get it. You're always told, you're brought up thinking gold is a good hedge against the S&P. Historically, it is, okay? But we are starting to see gold futures sell off with the overall market. So if you want to hedge playing the metals, in my opinion, GLD, the ticker symbol GLD, the S&P GLD ETF right there, or the Spider GLD ETF, in my opinion, historically outperforms GDX in individual gold stocks.